Picture a kitchen table anywhere in America, late 2005. A couple, maybe not wealthy, maybe a little stressed, sits across from a mortgage broker. They're dreaming of a home. The broker smiles, slides a document across the table. It's a subprime loan designed for people with shaky credit. The terms are a little fuzzy, adjustable after a few years, but the monthly payment is low for now. This moment, this single loan, felt like a private transaction, a hopeful step into the American dream. But in a dizzying, invisible chain reaction, that piece of paper and millions like, it would ignite the worst financial crisis since the Great Depression, shaking every corner of the global economy to its core. How did a loan for a modest home, tucked away in some suburban neighborhood, become a weapon of mass financial destruction? How did it morph from a local deal into a phantom menace that haunted balance sheets on Wall Street, in London, and across Asia? The story isn't just about bad loans. It's about a hidden architecture of risk, built with meticulous precision, piece by piece, until it stood poised to topple everything. The stage was set years earlier. After the dot-com bust and a minor recession in the early 2000s, the Federal Reserve, under Chairman Alan Greenspan, kept interest rates unusually low. Money was cheap and investors, starved for yield, went hunting for better returns than traditional government bonds offered. This created fertile ground for the housing market, which rapidly became a major engine of economic growth. Mortgage securitization, the practice of bundling individual loans into tradable securities, exploded. It was a financial innovation meant to spread risk, but it also masked it. Soon, the hunt for yield and the demand for these new securities fueled a relentless push for more mortgages, any mortgages, even those to borrowers with less than stellar credit. The old rules of lending began to fray. The problem was simple. The supply of creditworthy borrowers eventually ran dry, but the mortgage machine couldn't stop. Investment banks on Wall Street had developed a voracious appetite for mortgages to feed into their complex financial products. To meet this demand, mortgage lenders, like Countrywide Financial and New Century Financial, began to aggressively issue subprime loans. These were mortgages given to borrowers with weak credit histories, often with little to no documentation of income or assets, dubbed liar loans by some in the industry. Many were adjustable rate mortgages, or ARMs, which offered artificially low teaser rates for the first few years only to reset to much higher payments later. As long as home prices kept rising, it seemed fine. Borrowers could simply refinance or sell their homes for a profit. But this ever-rising tide of home values was precisely what masked the true, accumulating credit risk beneath the surface. By 2006, the subprime frenzy reached its peak. Approximately $600 billion of these risky mortgages were originated, making up a staggering 23.5% of all mortgages that year. But the housing market, which had been defying gravity for so long, began to wobble. Home prices started leveling off, then for the first time in years actually fell in some areas. The fragile edifice began to crack. Subprime adjustable rate mortgages, the very instruments designed to pull in marginal borrowers, started to see increasing delinquencies. The low teaser rates expired, payments jumped, and homeowners found themselves trapped, unable to refinance or sell. The first domino fell in April 2007, when New Century Financial, a major subprime lender, filed for bankruptcy. Wall Street, however, largely dismissed it as an isolated incident. They were wrong. Just a few months later, in the summer of 2007, two hedge funds at Warren, the venerable investment bank Bear Stearns collapsed, specifically due to their heavy losses on mortgage-related investments. Panic began to ripple through the system. Interbank lending, the crucial grease in the gears of global finance, started to seize up. Global investors finally understood. The risk was not isolated, it was systemic, woven into the fabric of the financial world far deeper than anyone had imagined. The genius, or perhaps the madness, of modern finance was its ability to turn lead into gold, or at least subprime mortgages into A-rated securities. Investment banks didn't just buy these risky loans, they transformed them. Thousands of individual mortgages were pooled together into complex mortgage-backed securities, or MBSs. These MBSs were then sliced into tranches, each with a different risk profile and payout order. The riskiest equity tranches absorbed the first losses, the mezzanine tranches were next, and the senior tranches were supposed to be nearly bulletproof. But the banks didn't stop there. They took the lower-rated mezzanine pieces from many different MBSs and bundled those together. again into even more complex instruments called collateralized debt obligations, or CDOs. And then came the truly shocking part. The major rating agencies, Moody's, Standard & Poor's, and Fitch, stamped massive portions of these senior CDO tranches with the highest possible rating, A. This meant institutions like pension funds and insurers, legally restricted to holding only the safest assets, could now invest in products ultimately backed by pools of the riskiest mortgages. The agencies, paid by the very banks whose products they rated, became, in the words of the Financial Crisis Inquiry Commission, essential cogs in the wheel of financial destruction. By September 2008, the financial system was on the precipice. The government had already taken the unprecedented step of rescuing Fannie Mae and Freddie Mac, two giant mortgage guarantors, placing them into conservatorship on September 7th, their obligations totaling approximately $1.6 trillion. But the real earthquake hit on September 15th. Lehman Brothers, a venerable investment bank with over 150 years of history, filed for bankruptcy. With $639 billion in assets, it was the largest bankruptcy in U.S. history at the time. The shockwaves were immediate and brutal. The very next day, the government was forced to mount an $85 billion rescue of American International Group, or AIG, the world's largest insurer. AIG hadn't just insured homes, it had sold vast quantities of credit default swaps, essentially insurance policies against these now toxic mortgage-backed securities, with a notional value of $527 billion. When the underlying mortgages failed, AIG faced astronomical payouts it couldn't cover. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke watched in horror as money market funds, the bedrock of short-term corporate finance, experienced a terrifying run. Credit markets seized and bank after bank teetered on the brink. The global financial system, they warned Congress, was on the verge of collapse. On October 3rd, Congress passed the Troubled Asset Relief Program, or TARP, authorizing up to $700 billion to stabilize the crumbling system, an unimaginable sum just months before. It was a desperate gamble to prevent a total economic meltdown. The extraordinary interventions, including central banks worldwide purchasing approximately $5 trillion in government and troubled assets, and governments injecting $5 trillion into banking systems through recapitalizations, slowly pulled the global economy back from the brink. The immediate panic subsided, but the damage was profound. The International Monetary Fund estimated eventual losses from the crisis around $5 trillion. Financial firms had already written down roughly $501 billion of subprime-related assets by August 2008 alone. The U.S. and global economies plunged into a deep recession that stretched into 2009. While the system didn't utterly collapse, the aftershocks were felt for years. The regulatory landscape shifted, with new rules aimed at preventing a repeat, though debates about their effectiveness continue. The crisis highlighted the immense interconnected fragility of the global financial system, where a single, seemingly insignificant subprime mortgage could, through a labyrinthine chain of financial engineering, trigger a catastrophe of epic proportions. The story of that single subprime mortgage reveals a crucial truth. Complexity, when unchecked by transparency and accountability, creates vulnerability. The crisis wasn't just a failure of individual loans, but a systemic breakdown fueled by perverse incentives at every level. Mortgage lenders pushed loans with minimal oversight, investment banks crafted impenetrable products, rating agencies blessed them with undeserved ratings, and regulators watched, largely paralyzed. It's a stark reminder that in the pursuit of profit, the foundational principles of sound lending and risk management can be abandoned, leaving everyone, from the hopeful homeowner to the most sophisticated global investor, exposed. The lesson is that the invisible hand of the market needs careful and constant oversight because, when left entirely to its own devices, it can build magnificent yet terrifyingly unstable towers of risk. If this deep dive into the 2008 crisis opened your eyes to the hidden complexities of our financial world, you might be interested in our other explorations of economic history. Consider subscribing to stay informed and let me know in the comments. What other financial mysteries would you like us to unravel?